Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're speaking with Professor Matt Sherwood, who is CEO and CIO of Pathos Partners, LLC. He is a guest lecturer at Columbia University, where he teaches on ESG investing, the green economy, and economic theory. Previously, he worked at Morgan Stanley and the Schoenfeld Group and Ivy Strategy. He graduated summa cum laude from Liberty University. There, he also earned his MBA and his PhD. He is the author of 2 pieces of excellent research and a book which you can all find on the show notes of our website. So, Matt, thank you for being here.
Rob, thank you so much for having me. Real pleasure to be here, and thanks to everyone at the CFA Society New York. Great things that CFA does.
Great. So one of the first questions I have for you is just to talk a little bit about what your firm does, because this carbon sequestration thing is kind of remote for lots of people. So why don't we start there?
Yeah, excellent. Well, Pothos Partners is named after the Pothos plant. The golden Pothos plant is actually sequesters the most carbon out of any plant in the plant world. And it's also hard to kill. So we love that as a name. And what we do, well, we're focused on anything in the green economy, but we're specifically right now focused on a special situation fund, and is taking advantage of a unique and compelling special situation in the California carbon emission allowances market. So I can elaborate on that because I know that's still probably very confusing. But California created the cap and trade program. This was under Arnold Schwarzenegger, Republican governor of California, passed with supermajority in the House and state Senate, and it's been around for over 3 governors. It's certainly not a nascent market, very mature market. And the goal of this market is to reduce carbon emissions. And the way, they have near-term goals of 2030 to have a 40% reduction of 1990 level greenhouse gases, and then at 2045, having an 85% reduction of 1990 level greenhouse gases. So the program was created to have these reductions. 1 carbon allowance represents 1 metric ton of carbon emission. Mm-hmm. And all emitters or polluters that are polluting at least 5,000 metric tons of carbon emission a year must be compliant. And they must even be compliant if they may be based outside of California jurisdiction. For example, an Arizona or Nevada power plant putting power into the grid to California. Mm-hmm. For us, we look at this as, there's a tremendous opportunity. It's uncorrelated to any kind of credit beta or equity beta. And it's one of the few investment opportunities that exist that the government's a true tailwind. They are motivated to get the prices higher.
Right. There's a sort of supply-demand thing that's inbuilt in here, right?
Correct. That's beautiful supply-demand.
Just to take members back for a second, for those of you who weren't paying exceptionally close attention, California has really spread its wings on this by having basically requiring counterparties, anybody who does business in California, to also, or on a large level, to comply with this as well. So it's not just California, in that it's big enough. It's in some years bigger than France, but it is also reaching a little bit beyond the California border.
Correct. Yeah, and California. Let's keep in mind, California is the 5th largest economy in the world, behind Germany.
No,
right?
It's behind Germany now. Yeah.
So
yeah, right. It's like, it's hard to advocate for it, but there it is.
But just the size of this market is huge. I mean, this market now, with reducing after over 10 years of auctions, quarterly auctions, each year there's a reduction of the supply of these carbon allowances, really to create scarcity and put pressure on polluters to change their infrastructure. That's the goal of this program. These are really tradable compliance instruments that are really more or less a stopgap to really until the polluters and the emitters can change their massive infrastructure and technologies. For that, even with a decreasing supply, this represents now 4% of California's state budget.
Yeah. Oh, wow. Okay.
It's a big market.
Yeah. We're actually here speaking on January 24th, and Matt was just on the podium here at CFA New York speaking, and a little bit about what you talked about was the analytical challenges that remain in ESG portfolio management. And, could you talk a little bit about that from your expertise as a practitioner?
Yeah, so I've worked with ESG factors for many years in ESG analytics. This sounds very awkward every time I say it, but I wrote the textbook on ESG investing. It's used at MIT and Harvard, Cambridge, Oxford, Berkeley. It's one thing that I wanted to do to really create more standardization. And I think, standardization is like the biggest difficulty we see with portfolio analytics and really anything to integrate ESG because everyone has different views. So I think that's the biggest challenge. Continuing to face, investors. However, there's exceptional opportunities for alpha generation and risk mitigation through ESG analytics. It helps understand your portfolio, any risk associated, and let's be honest, right? Non-financial performance factors make a true impact on financial performance.
Yeah, well, let's actually talk about that from sort of the back of that list you just made, because one thing that the analysts, portfolio managers, et cetera, who listen to this podcast are mostly concerned about is risk. And you've written a lot about the risk premia involved in this. So could you talk a little bit about not only the comparability of data, but how you experience that on a day-to-day basis?
Yeah, so I believe you're referring to my establishing ESG as risk premia paper.
I am.
This was got a lot of recognition, mainly around the CFA crowds. But it was in the Journal of Investment Management, and what myself and two of some mentees that one that I taught and a former mentee of mine who's doing exceptional things, we looked at Farmer-French factor analysis. And to establish ESG as a true factor, we looked at the changes on these ESG ratings. We triangulate them to see how the delta move, so basically the positive movement in the that rating or that quality, the ESG quality of a company, whether it's their associated their credit or equity, how that would have a latency effect to really have a risk premia, so an opportunity for alpha. And it's similar to what others will look at, like tail risk ratios or skewness in the options market. Mm-hmm. And we were blown away on how successful it was. Yeah. And it rates up there just the same as other factors such as momentum or small cap growth. Like there's some true opportunities that we learned about through this paper, and particularly when you have higher gamma moves in the ratings to show transition. And what made me want to do this paper actually and study this, and my hypothesis came was actually, I'm not going to name the company, but there was a multi-billion-dollar market cap textile company in Brazil, and the company had issues with their management team, ended up getting a new management team. They owed a lot of taxes to the Brazilian government, and the management team said, we're going to adopt GAAP accounting. Wow, what a big change, right? Like what a huge, phenomenal change. But there's ESG ratings, and ESG research recognize this as a momentous change, right? Yeah. A standardization on accounting. And the stock market didn't have any impact or change for the first 2 quarters. Mm-hmm. And however, 3 quarters after that, there was a 3x in the price of the stock, right? Okay. So it was a real risk premium that was exploited there, and it's something we wanted to identify and incorporate into our paper. And it wasn't just an idiosyncratic event with that company, right? This is a true risk premium that exists in the market.
Right. I mean, I would encourage everyone who does take a look at this paper to take a look at the comparisons you made, particularly on the skewness topic, because that was really, to me, interesting way of coming at it that's been different, that was perhaps enabled. A lot of it has been return-based or alpha-based, which is perhaps enabled by the very strong performance of ESG stocks nigh about 2 years ago now. So, I think it took people's eye off the balls, and I think yours brought it back to a risk-adjusted return place, which is much more important.
And I'll just jump in on that. Part of the market, particularly like institutional investors, looked at, these ESG factors, and they would only want to screen in or include, right, they'd exclude everything else, the top-rated companies. Mm-hmm. We took a different look or a different perspective rather, and we looked and identified companies that are improving, And and because that's really you want to benefit from the improvements, not the improvements that have already been made.
Right.
So little nuance there, and I think it certainly you saw the efficacy in the data, right?
Yeah, for sure. It's all there in black and white. I did want to roll back to a little bit about your book, which, in case anybody's wondering, you can find it once again in our show notes or in just about every business school near you pretty soon, right? So is that the level it's being taught in? Is it MBA or is it an undergrad book?
Both undergrad and MBA. I know there's some like sustainability certificate at MIT that requires, actually 6 courses. MIT is doing great things there. Rutledge, we did the first edition through Rutledge. They came to us for a second edition because of demand. And I'm just happy because, ESG investing, it's just a part of fundamental analysis, right? It's just a part of investing, but it's something that most traditional textbooks are not covering.
Right.
And there's a lot of intricacies there and methodologies that really benefits investors. So I'm glad that, the next generations, are taking it or are required to take it.
Yeah. Well, it was funny when you mentioned the revolutionary gap accounting. I was trying to remember when that was included in the CFA curriculum first. I think it was probably in the 90s. So it stuck with some of us, but
CFA is ahead of the Not surprisingly, CFA is ahead of the crowd.
Right. So Matt, thank you very much for being here on the podcast. Thank you very much for joining me. So those of you who are listening, once again, you'll be able to see links to. I'm going to put a ResearchGate.net link in there for Matt's paper, for showing where you can buy find the book and download some other stuff. Also, if you visit CFA New York's website, in approximately 1 week's time, or basically after this podcast drops, you'll be able to watch Matt and the other panelists who spoke at our event here today. So thanks again, Matt.
Thank you so much for having me, Rob. Really appreciate it.
And thank you all for listening. Until next time, I'm your host, Rob Rowan, and this has been Compound Insights.